Hi, everyone, and thanks so much for joining us today. My name is Yulia, and I'm part of the customer success team here at Snap Projections. I'm super excited to go over this drop in training session with you today. I also have Lee Martinson here, who's a manager of our customer success team. So today, this will be a live product walkthrough focusing on frequently asked questions by our users. Please feel free to participate throughout this session by submitting your questions. You can do this in the GoToWebinar portal. So if you open up your portal, go to the question mark and then submit it there. I will be able to see throughout this session and address those live. We will be recording this session and we'll send it out to you after we're done. So please feel free to step away for any reason if you need to. Or if you want to revisit any of this information, this will be available to you. And again, we will have some dedicated time for questions later, so please feel free to submit them. Okay, great, let's jump in. The first question that I always get is, what information do I need to create a projection? So before I answer it, let me just, okay, so I already logged into Snap Projections. You can see here some scenarios that are previously created. What I also want to show you is how to find useful information, because the first question is, what information do I need to create a projection? And we actually have an article available in our Help Center. So it's right on top over here, Help Center. Start Here is a wonderful collection of articles, especially useful in your early days with Snap. One of them is Snap Projections Toolkit over here. I highly recommend you to read through it. My colleagues created these financial planning questionnaires, both in long and short versions. They are free to use and just a wonderful resource to have for your client meetings. But let's go back to Snap. So in order to create a projection, I need 4 key things. It's year of birth and province of residence, sources of income, asset values at the start of the year of projection, available contribution room, and how much the client is saving, if at all. So that's 4 things and about 10-15 minutes. So let me prove this to you by creating a plan quickly. And while I do that, I'll answer other frequently asked questions. So where do I start? And let's push the largest button on the screen, really. Okay, so we'll enter information for Joanna Snapper and John Snapper. 1 second. Both of them are born in 1985. And I'm going to put January 1st here. You basically don't even have to input the client's exact date of birth. You can simply put January 1st of that year if you don't want to. And John Snapper, born same year. Notice how the editing of the fields and clicking away from them changes the button at the bottom from edited orange to green saved. So it means that you don't have to click any save buttons anywhere. As Snap actually helps you in this, it does it for you almost everywhere. And you can also see that on top of your screen, your client names appear right on top here. This is an indication that Snap finished creating the clients for you already, just at this stage, at this first screen. And it gave your scenario this name, which is scenario 1 by default for all new clients. And here's the second frequently asked questions that I get. It's how to rename this, which is super easy actually. You just click on it and you can change the scenario here, or there is this hamburger icon. You can select from the drop-down menu, rename scenario. My habit is to call the very first scenario for a client as base scenario. It's to reflect the client's current state without yet incorporating any drastic life changes that they're thinking about, or even without my planned recommendations yet, but it's just a base scenario. So moving on, I can click the next button on the screen, but I don't have to. If you remember before, I told you that I only need 4 things to finish working on the plan. And the next one on my list is the sources of income. So I can jump right over here. I quite like how on this side, I have the list of all available screens for me, and it's much easier for me to navigate through it. So I'll start with employment income. And Joanna is working for decent company, and she's getting a small raise every year to cover inflation. So I'm going to remove the 0 and see how it immediately defaults to general inflation. Snap will consider it during future calculations, indexing this amount by the general inflation rate. I'm going to make sure that this is the right type employment, that it's taxable, RSP eligible, and goes until retirement. I'm just going to assume for now that my clients will retire at the standard retirement age of 65. I can change it later if I need to. But for now, I'm just going to switch to John's side over here and make these changes for him. So Jacob has a slightly smaller salary, and raises are not a regular occurrence for him, so we will leave the indexing at 0%. And let's go back to Joanna. The next thing on my list is capital assets. Okay, so it gives us like a template to work on. I can change this. My couple has a joint cash account. And they've saved up some money. Okay, sorry. And this is a non-registered account, and this is joint. Let's keep everything in cash for now. Okay, so Joanna also has a small TFSA. And let's select TFSA. And it's just 50-50 in equities and fixed income. She also has an RSP. Okay. And we'll just keep it the same. And another thing that she has is an employer savings plan, actually, with her employer for matching contributions. I'm going to add this one here quickly. Let's just put, okay, it's going to be RSP. All right. So Before I switch to John's side, I want to make sure to review these tabs on top over here. So TFSA contribution room is very important. We know that her account is quite small, so we need to tell our application Snap just how much she can contribute in the first year of projection. For a 39-year-old, she has a 65,000 more that of unused contribution room. I'm also going to check her RSP, her contribution room over here. This one is going to be calculated by SNAP for you based on employment income that you entered. But if I knew that she had some carryover room from the previous year, I would have added this amount on top of this one. Let's look at the employer matching. So I'm entering, okay, I'm going to enter exactly what Joanna told me. She told me that only one of her account is linked to her employment income, and she's contributing 5%, and her employer matches exactly that. So we answered the question how to adjust the contribution room and set up employer matching for our clients. Now let's switch to John. Notice how this cash account already appeared here. It's a joint account, and this is because Snap is smart and helps you to not duplicate your work. This default account, though, I'm just going to delete this. Okay. I'm just going to keep his cash account, and I'm also going to add a TFSA account similar to his wife's, also a small one, TFSA. Okay. And I'm going to do the same thing for him. I'm going to increase his contribution room for the first year. All right. We can now look at our planning page, actually. For the second to the like we're almost there. We're almost done setting up this plan. Let's take a look at this. This page looks like a lot the first time you look at it. However, very quickly it becomes your best friend because this is where the magic happens in Snap. On the combined side over here, we can see the incomes. You can see that the income is growing throughout the year, but if you expand this field over here, you will see that only Joanna's income is being indexed at general inflation, and John's income stays consistent throughout the plan. Okay, and okay. And in the retirement, you can see that this income turns to zero, but they start getting some benefits. You probably noticed also on the side here, we have their capital assets, how their portfolio grows, but there's a lot of zeros here because we didn't tell Snap yet if the clients are saving anything to their plan or not. So what we're going to do is go to the individual side and let's just fix that. So my client told me that she's thinking of gradually maximizing her TFSA, starting with $20,000 for as long as there is a contribution room available. And then she wants to do the maximum amount until retirement. So the question number 4 actually that we get is how to maximize contributions to TFSA. So what I'm going to do is actually under TFSA contribution withdrawal, I'm going to put the amount 20,000 and copy it down to 64. I know it looks a lot because we have the maximum contribution room is 7,000, but let's just run the scenario and see what happens. So SNAP keeps the $20,000 for as long as there is an extra room available, and then it changes to the yearly maximums. And you can actually hover and you will see the actual amount that would be allowed to contribute. So you didn't have to enter these amounts for each year. You just need to put one large amount and then copy it down. Or if she wanted to fully maximize in the first year, I would have inputted like 70,000 there and copied down. It would have replaced the values for me. All right. I also know that she wants to maximize her RSP contributions. But because she has this employer matching going on, you see the amounts being contributed. I don't want to do the math and include like what exactly to put here. I'm gonna ask Snap to calculate it for me. So for now, I'm just gonna put the 20,000 again and copy it down to 64 and run the scenario. So here you go. These would be the balances that my client is safe to contribute without risking over contributing while her employment matching is going on as well. Okay, now I'm just gonna do very quickly a similar thing on John's side for TFSA. Okay, and run the scenario again. Let's go back to combine and let's take a look on the expenses side over here. If I scroll down at retirement, it turns to 0, which is not right. We skipped this step in the scenario setup because we didn't have this info from our clients yet, but it didn't stop us to start working on the plan. So I will talk about these expenses in detail in just a second. But to finish this projection, I just need to look at what's happening in the columns above that pre-retirement. Snap calculated for me these amounts in italics. These are the funds left from the income my clients earned after all taxes have been paid and any contributions have been made. And Snap assumes that the client basically spends the rest. So I'm going to visually scan through this, and I'm just going to see that on average they spend about $100,000 per year. And I will just assume that the clients want to keep the same standard of living in retirement. So I will take this number. I can enter this here, but I would want to do this also on the expenses screen over here. I'm just going to put 100,000. I will later discuss this number maybe with the client to see if it's close to reality, or maybe they're actually saving more somewhere, or there are debts that they forgot to tell me about. So for now, I'm just putting this here, and that's really it. This is the end, and we finished the basic scenario setup for a couple in just over 10 minutes, about 15. And the information that I needed to create this projection was client's year of birth, province of residence, sources of income, asset values, and how much the clients are saving today. But let's talk more about this base expenses. Because the next question on my list is, what do base expenses consist of, and what do I put under additional expenses? So I would like you to think about base expenses as your client's primary retirement goal. How much they want to spend in their retirement for living expenses. Those are their groceries, utilities, transportation, Netflix subscription, and medication if they have regular expenses there. Anything they can't or don't want to live without. If your clients have an itemized budget, great. They can give you this total number right away. You do not have to go and itemize everything for them. But as I showed you before, you don't have to have this number. You can estimate it through the planning page. I also want to highlight that this number does not include their debt payments or insurance premiums, because it's best if you enter them at the appropriate screens over here, and for the insurance. It also doesn't include any expenses that are calculated automatically, such as income taxes or EI premiums. And below are additional expenses. So this is something that I encourage people to think about as additional financial goals throughout the client's lifetime, like buying a new car every 5 years, or taking that super expensive trip to feed polar bears, or commitment to renovate their kitchen next year. So just for the sake of the exercise, I'm going to enter a recurring vacation every couple of years. And I'm going to make it joint. And starting next year, so I can put 2025. Okay, and let's say to age 80, every couple of years. And the next commonly asked question is, why is there a shortfall? So what I can actually take a look, let's look at the planning page on the combined. We can see these expenses adding up. And at some point in the future, actually, in the last year of projections, we see the clients running into smart shortfall. Maybe I can, over here. So I can show it a little bit more. Let's just think, you see how the cash non-registered account has zeros in it. I could have just actually, a very common mistake that we make is I could have set an override to a 0 throughout the whole plan. And you will see, just one second. And you will see my clients running into shortfall much sooner than that. I even get a pop-up over here. It's a warning. It tells me that I might be restricting SNAP from accessing certain funds for my clients, and it gives me a link to read more information over there. So when SNAP actually gives you these articles to read, I highly encourage you to allocate some time and actually review them. We have a very thorough knowledge base, but I'm going to go back quickly. Click OK, and I want to show you. These are the shortfalls. This is how they look like. And okay. So these zeros over here, they're not letting SNAP withdraw funds from this account when the client needs them. I can clear it on the little axis, if I just click the little X, but that's a lot of X's to click. So the quickest way to do this is actually go all the way back, and I can just remove this value, copy it down to the end of the plan, and hit this clear override, and just hit OK. And run the scenario. Okay, so it undid the information for me. So the only other reason for the shortfall right now is because my client is simply running out of money for this last plan, last year of the plan. Okay, so what we can do right now is we can start coming up with ideas for the clients on how not to run into the shortfall. And if you have an immediate idea how to do that, you can copy scenario and start working on this. So the next question is how to actually copy scenarios. And you can do it easily from up here. You can click on the menu copy scenario and change the name to something that makes sense to you. So in this scenario for me, I can, okay, let me see what else I can do. Okay, let me just go back and I can switch between scenarios. So I'm going to switch back to the base scenario. And just to make it a little bit more fun, I'm going to add a real asset for them. So their house, let's make it, okay. And okay, I missed a 0 here. All right, so let's see. They have a house and they probably have a mortgage associated with that. Okay, and the balance, they will probably, let's put this here at 5%. And it's a current mortgage, and they're probably, okay, so I can select the interest only, or I can select interest and principal, and let's put maybe 3,000 monthly. And it's a joint asset, so it's a joint mortgage, and I'm gonna link it to, okay, to their house over here. Now that the couple has a debt, there will probably be, you can see the real assets over here and the debt being paid off gradually. Okay, so now I'm gonna make a copy of this scenario, and maybe they would like to sell this house eventually. So I'm gonna copy this scenario and name it to something that they make sense to me, like selling a house at 80. Okay, so I can go back to scenario setup under assets, and I can put the future sale age. Let's put 80 over here, and let's see what happens. I can actually, okay, let's go to the planning page, and on the combined, okay. So when my clients turn 80, we see that this asset is being sold, but they actually paid off the debt before then. So there was no more debt until that time. But if it was, then the debt would have been paid out that same year. Okay. Now, another thing I wanted to show you is how to compare these scenarios, which can easily be done through the state before tax icon over here. So this is my current scenario that I'm currently in, but I'm also have two other scenarios, base scenario, and I can compare the total assets for the plan where we sold the house and the assets for the base scenario that we had before. We can see different debts if they had. We can see the total tax on the state and others. And the thing is, you can do this not just, these numbers shown here are at the plan end, but you can look at this and compare scenarios for each year of the plan simply by clicking on this number. It will pull up the information for you very, very quickly. Okay. Now I think what I wanted to show you, and it's going to be the last question for today, is how to convert RSPs to RIFs sooner. So currently they're set up for 71. When clients turn to 71, their RSP accounts start actually withdrawing the money. And this is how much the money needs to be withdrawn at certain periods of time. But if I want to change this, I can go to capital assets for Joanna for RSPs over here. I can change the conversion age to, let's say, 64 or 65. I think you can go as low as 55 in some provinces. So I can select that. And on the planning page for Joanna, I can see these withdrawals actually starting to happen sooner over here. And those are the minimum withdrawals. Snap already calculated it for me. Okay, before I review any questions that you submitted, I want to add that there are still many more frequently asked questions that I didn't get to answer today. Snap offers many features that I haven't mentioned, like interactive charts on top, where you can just show different things to your clients. We have recommendations, we have clients reports, corporations, and insurance. There will be more opportunities for us to cover these topics in the future. But there are a few important things about Snap's interface that I do still want to share with you. And that anything highlighted in yellow on the planning pages, it's called an override. It highlights the manual entries to easily tell them apart from entries generated by Snap itself. So use them wisely and review them frequently as you're working on the plan. Another thing is, if you patiently hover over things, you might get extra clues. So for example, if you hover over TFSAs, it will tell you how much room the client has in a particular year, or the minimum maximum withdrawals you can do on RSP accounts, LEAF accounts, etc. You can also just hold your mouse and drag the whole page for ease of navigation. Um, Another thing is anything blue is clickable. Like anything that you see here is clickable, either to enter amounts or to edit some information quickly. Usually it opens up these new menus, or there are some buttons here that you can review. Um, so explore. I highly encourage to explore. The headers on top, they will lead you to the appropriate sections in the scenario setup. So they're blue, they're also clickable. And hover over question marks where you see them. All of them have different clues of what's going on and what Snap actually asks you to enter. Well, this is it for me today. Let me just quickly take a look if we have questions.
Thanks, Julia. Yeah, there's one question. If you
Mhm.
could just talk a little bit about where does the money go once you've sold that real asset? What happens in the projections?
Okay, absolutely. So in the projections, when we go to the moment the house is sold, so let me go to the combined. Okay, so Snap will do a series of iterations. It will take a look at any debts that you currently have associated with the property that was sold. So if you had a mortgage, then it would have paid out this mortgage first. And then it includes this asset, this value as available asset for contributions to your capital assets available. So in this case, the majority is being contributed to, okay, so at this point of time, RSPs have already turned to RIFs, so SNAP couldn't contribute there, but it contributed to TFSA, the maximum it could at age 80, and the rest went to a cash account. So it was automatically reinvested into capital assets. Yes, if the sale of the house happened prior to retirement, prior to the start age of cash flow management that we have on top, that I didn't get to talk to a lot today, but Snap would have needed your additional input of what to do with the money, with this huge influx of cash in your client's plan. You would have seen it under this real expenses as like we have 62,000 over here. But if you sold the house, you would have seen like $3 million over here. So keep an eye out on it. And if that cash is available for your clients to save somewhere, make sure it's allocated to one of your capital assets. Does this answer your question?
Yeah, that's great, Julia. And definitely there's a lot more we could cover about, where even in the automatic cash flow, if you didn't want that money to go to one
Mm-hmm.
specific account, you could stop that from happening, or you could change the rate of return for that non-registered asset from 1% because now they've invested a bunch of money. So midway through the plan, you can also like change the rates or the
Mm-hmm.
asset allocation. Um,
Yes, exactly. Like there's $600,000 and it's no longer 1%. We can include it right over here. Maybe it's no longer 100% cash, but it's like 20 cash, 20 fixed income, and 60 equity. Yeah, you can do it right here, and it will apply until the end of the projections. But don't forget to run the scenario when that happens.
Right. Yeah,
Yes.
and there's lots of things when someone sells their house, like you might want to increase their lifestyle expenses because perhaps they're going to be paying for rent now and just other things to
Uh-huh.
think about. But that's a great overview yeah, of what to do there. So I think,
Okay.
yeah, just point everyone to where they can get help if they have more questions, and we'll
Yes.
end it for
So
the day.
again, the help is right on top here. You can click on the help center, and we have our phone number and extension over here. Um, Another thing you can create, just send us a message. This will send an email to our inbox and we'll quickly get back to you. Mm, all right. I think we will finish for today. Thank you
Okay.
very much.
Thanks everyone for joining.